Okay, hello traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, March 21st, the aftermath of yesterday's FOMC decision. Hope some of you guys caught that volatility. Lots to discuss today. Good morning. Aurelian is in the house today. Jaya, come on, Mark, Marco, Peter, Pete, Pooja, Ziad. Great to see you guys this morning. So on the menu, obviously DXY, Euro, Aussie, Kiwi, gold, big move here. Dollar yen made the move lower. Crude still holding big resistance, and that's what's on my menu. We'll take a quick look at sterling. Finally did break down, as was our favorite expectation on a dollar stronger story, was CAD and sterling, both playing out pretty well actually. And we'll go over those in their entirety as well. Dollar CAD, we do have retail sales tomorrow and CPI figures, so we'll take a look at that as well. Ziad, great to see you in the room. All right. Any other questions or trade setups, guys? As always, feel free to throw them on the message board at any time. So, where do we begin? I've had a couple of interviews, guys, with financial news publications over last 24 hours. I've been having a lot of discussions with guys on the desk here in the city. Everyone's got their own take on what exactly happened yesterday, but I want to be as objective as possible. So obviously, guys, our focus is on price, and we're all technicals here, but a quick roundabout so we know where we are in the fundamental backdrop. Yesterday's announcement came out. Here's what the updated dot plot looks like. I shared this on SB Squawk and my Twitter handle. And just some things to note. Again, objectivity. Whether you think the Fed's making a mistake, they're accelerated, they're slow, they're lagging, they're going to overshoot, whatever your opinion is, here's what the market says and here's what the Fed says, okay? Last December, here was the expectation heading to 2019, okay? You had 5 members or 6 members above 3%. You had 5 members below 3%. This is about 275. And then this was the mean, basically, right in here. Here's what they look like now. No members. So from 5 or 6 rather members above 3%, no members above 3%. Okay, and now the mean drops right to where rates are right now, suggesting that the Fed is saying expectations are we probably won't raise rates this year. That says nothing to the longer term cycle. That says nothing that they're halting or reversing the tightening cycle, but it certainly says that right now expectations are will probably hold. So you think to yourself, okay, well, that's what the Fed's saying, right? Well, what's the market saying? Well, here's what Fed fund futures are saying. Okay, this I showed you guys in the webinar yesterday. There was about 25% chance that markets were actually pricing in the possibility for a cut. That has grown to almost 40%, over 40% of market participants thinking that the Fed's actually going to have to not hike, but cut rates, right? So this, by the way, what we're looking at here, guys, is Fed fund futures for December of this year. So at the end of the year, where is interest rates going to be? This is where we are now, this checkered one. And 57% of market participants think we're going to be at that rate at the end of the year. But there's a growing consensus that we might actually cut. So what's that mismatch? Basically, the market went into the FOMC thinking we're not going to get a cut. The Fed was saying 2 hikes. The Fed now adjusted to 0 hikes. Market's a little bit even softer. Okay, so just put things in perspective. And this doesn't mean anything for the longer term, outlook of what the Fed's going to be looking to do with their cycle. Here's what the updated economic projections look like. A slight softening in the GDP from 2.3 to 2.1, a slight softening in the unemployment rate from 3.5 to 3.7, a slight softening in the headline inflation from 1.9 to 1.8. So outlook and forecast for growth is softer, employment is softer, inflation is softer, and also lowered their interest rate forecast. If that's not dovish, I don't know what is. Okay. Now, what does that mean for price? And this is where our expertise comes into play. At the end of the day, was the dollar primed for a turn? Were we coming off resistance? Did we break support? Weekly chart. We've been looking at this for a while, right? We came just ahead of that 618 retracement, the entire 2017 drop. You had slope there. We turned there earlier in the month. This was the first area of support we were talking about, 95.66. Okay, you have the 200 week moving average, and the low week close for the year. Here's what the daily chart look like. There's that support level. Here's the break we made yesterday. We dropped right into it, just lower, 95.55, 95.60. Okay, 786 retracement. Again, the low day close and slope support. We're rebounding off that moving average now. We're testing monthly open resistance now. And last night on the update, I said, look, if we're going to rebound from here, look for resistance at the monthly open. That's 96.22. A break above 96.30 would kind of put us on the sidelines. Here's what we're doing right now. Okay, we're there. We're there. So if the market's going to hold, we kind of need to hold right here. Sure, we could pop up, hit that former slope resistant support as resistance. Again, check that former opening range low. Wouldn't sort of invalidate the trade, but we do want to be looking for resistance here. Now, another thing that I was debating with yesterday is whether to alter this near-term slope. This was a 3-point tag, 2, 3, 4. The break did see some acceleration, and when we broke it to the downside, it did accelerate, which is why I left this slope. But if you adjust that, yesterday's low was right at the low. See that? So even if this were to drift, go for a tag here and fail, I don't want to necessarily bail on the opportunity yet. Okay, so I just want to put that in perspective for everyone on the slope change there. Just a little bit of a gradient change. It had so many touches. I wanted to see if that lower parallel was going to get the convergence at the low day close, 95.55. Obviously, charged a little bit more of a rebound, so it's worth it to work with this slope now. Again, keeping the focus lower while within this channel. Now, I just want to show you this weekly chart for a second. Okay, so this is the level that we highlighted of confluence. This is basically the low we closed for the year and that 200 week, moving average. It could produce a more substantiated bounce. Ideal scenario, you kind of maybe go sideways here, but you break lower. Ultimately, we do want to see this break. If this legit, peaking process against this slope was good. But just leave that possibility. Again, 95.66, 95.55 really is the bigger region. The low day close, that's kind of the region I need to see break to validate the reversal in DXY. Okay, looks good. Don't want to get too overly confident about it just yet, but certainly the initial move is now coming right into the March lows. We want to use some prudence here on this rebound. Questions on the DXY? And you get some existing home sales data tomorrow, nothing major. All right, so looking for some exhaustion on a push higher here into the U.S. trade session. If this is legit, let's look for some confirmation. On a weekly basis, guys, we closed up 95.66. It looks golden, okay? Yearly low comes in right in line with that 52 yearly or weekly moving average, right? The yearly moving average. That's a pretty decent confluence now. Next week will be even bigger confluence. But you can see the stretch low comes in at 95 on the mark, 95.03, and the actual moving average comes in at 95.04. Okay, so it's right there. So that would be your next sort of key downside target on a break lower here. And guys, objectivity, right? That's also the objective yearly opening range lows. Slope support on a 3-point touch from last year, and that 52-week moving average. So really, that should definitely be a red circle there. Okay, that is DXY. On the other side of it, guys, just in case, trading is an if-then proposition. If it were to break the weekly opening range highs, that's the near-term bearish invalidation, or that's the bullish, suggestion that we're going to resume higher. So that's kind of a necessity if this breakdown is legit. All right, number 2, euro. Here's what the good old euro looks like. Well, we recovered above 113, obviously, and here's the test of the slope resistance we were talking about in the weekly chart. So slope resistance off last year's March high, some nice symmetry to it. Again, tested in April. This is the first real test of it, so we haven't seen a weekly close yet. But the area where we turned from, and we're looking for confirmation with a weekly close above. That would certainly bode well, and keep the focus towards that 115.70, 116 level. Huge region now. You got the 618 there. You got the this is the 200-day moving average, the outside reversal day that we made for the September high. It's the high day close. All converge right here in this 30 pip range. So longer term targets are absolutely clear. We need to clear this slope on a weekly close basis to get things moving higher in the euro. Here's what it looks like on the daily chart. Beautiful area of resistance, and it is objective resistance at, whoops, keep doing that, the yearly open. Okay, here's what euro looked like last night. We plowed right into it. The previous update right ahead of the FOMC, just a quick reminder, here's what the euro looked like. We were trading right below this resistance. The ideal scenario, as I told you guys, I was looking for a rip lower to fade to buy the bounce. We didn't get it. Okay, so if you were quick enough, you know, I'm not going to encourage chasing per se, but if you got into it, the levels played out really well, and the key open, yearly open resistance is where we find ourselves trading now. Okay, so pullback, near-term support at that former slope, that's what we're testing right now. Even if it gets down to 1370, 1366, the median line, still within the confines of the up, right? So I don't want to necessarily bail on it. But look on the daily chart, guys. This was a big region of resistance. Okay, yearly open resistance, 618 retracement of the yearly range, all objective things. And look what price action did. We wicked right into it. We didn't even close in the region. And here's the pullback. Could it produce a little bit more of a move lower? Sure. Here's momentum turning right at 60. Wouldn't be outside their own possibility to fake everyone out, give a deeper pullback. But the end of the day, we broke above monthly open resistance. We broke above the 100-day moving average. We broke above slope resistance. We kind of want to see this thing hold 113.60s if we're going to continue to move higher on this swing. Okay, so on these moves, guys, when you get these huge volatile moves, and we've talked about how, you know, volatility has been so contracted, let the market breathe a little bit. We'll get clarity on near-term price on the pullback to reassert another move. Here's the intraday chart. And again, the slope has just been pretty darn clean. Even on an FOMC rip, you overshot that 50 line, but not by much, 75% line, but not by much, right? And then it came right back. Here's monthly open resistance at 1445. So again, you know, the levels from last night unchanged. So here's 1385, basically right at that slope as we noted last night. Even if it drops a little bit lower, the ML 1366, 1365, that high, kind of want to see things start to taper off here if this is going to hold. Okay, a breach above 1445, you're looking at the high day close, guys, which comes in right at 115, 114.99.8. And that converges on the upper parallel. Might be a little too early to look up here, but that's the objective, you know, play on the breakout to the upside. Right now, I'm looking to see if we can find some support, a little bit of a drift lower into the US trade session. Any questions here on euro? Let's give you a farther out look here real quick. Here's the 240 minute. It's actually a really clean chart, you know. This was the slope that we're working with the highs. We can drop this now. I've left this on because once we broke it, look where we found support, right? That former parallel resistance. That was the origin of the breakout. It was the exact area we found support. And now we've broken these parallel series in purple. So let's remove this for the sake of clarity. And that's what we're looking at with the euro. Pretty clean. Can we look at the euro 10-minute, please? Yes, we can. Absolutely. Here's the 10, Pooja. Just snap some of these levels, make sure everything's right. Here's the 10-minute since the start of the week. Basically, if the New York session breaks upwards, it would be an entry. Did I miss a lot from the euro, says Eman? I think I'm mixing your questions here, Pooja. Eman saying, good morning, Michael. Sorry I was late. Did I miss a lot of the euro? So we're just going over the kind of tail end of it here, Eman. Pooja saying, basically, if New York session breaks upwards, it would be an entry. That could be a play. Yeah, that could be a play. So here's the thing that Pooja's saying, guys. So she's saying if the U.S. opening range breaks to the upside, would that be an entry against the low to play the recovery? Could be, Pooja, but what I want to say is before I start to look for resumption on the breakout higher, I would love to see some downslope break. So let me kind of see if I can address this real quick. Give me a second. Let's just see what this looks like. So lower low in price, lower low in price, lower low in price, and I'm not talking about wicks either. Okay, we're talking about momentum on the close for the candles. So that's clear divergence. In fact, you have a divergence trigger break here. So opening range highs 14. Yeah, that might be a decent trade, sure. But what I'm trying to say is, Pooja, even on a play like that, wouldn't be targeting anything beyond like just near-term downtrend resistance. If you want to, if we get into here, right, and you book some of that trade and put the stops at break even, I'm all about it. Because if we do see the break, 14.45, 15, here we come. But on the magnitude of the advance, you might see a little bit more chop, I think, before this thing actually makes a next big move. Long story short, yes, to put things simply, that would be a near-term trade setup, Eman. But just remember, again, the exhaustion on this push, just be nimble. Make sense? So Eman, or that was for Pooja. Eman, for your question, our basic objective here is this thing should hold 1366 if the breakout has legs on this initial stretch. Okay, so even if it were to break lower, I want to see support here. But ultimately, we rebounded off a big region. This is the first big region of resistance. Could get a little bit more kickback before we move higher. Pooja says, okay, thanks. You got it. So I guess we'll go in order here. Actually, let me just segue for a minute. The best plays, guys, I guess we should talk about this now since the DXY is kind of making a little bit of pull higher. The best plays for the long dollar trade, in my opinion, we had trades that were favored for the dollar short and dollar long. Long dollar trade, it was going to be sterling, and more importantly, it was going to be dollar CAD, because dollar CAD, if you notice, and this is something I'm not sure if Jamie tweeted this yesterday, but let me just take a quick segue here. Number 3 will be dollar CAD. And the last update for dollar CAD was back here. So here's dollar CAD. Came into the week, start setting an expectation that we want to see sort of a stretch near 1398, 134, 133.98, 134 for a short. Major key support 1290 at 32.90, excuse me. And then we were looking for a drop into this key level, right, on the ideal. So it broke on the FOMC, and despite the fact that the dollar collapsed versus so many different currencies, dollar CAD never made a new low. And this is something we pay attention to in near-term price action a lot. So here's dollar CAD at this point. First of all, a quick reminder of where we are in dollar CAD. Remember, we were talking about this chart early in the week, right? Slope support. This is a parallel of the same pitchfork that we've been working with off last year's low. Support, support, support. That was the 200-day moving average there too. Here's the 618. And here's the daily candles. Not one close below that key confluence region that we were highlighting, which is slope support, the original slope, former slope resistance, now turn support, and 200-day moving average. All of it was right in there. So we spiked right into it. We didn't make a close below. During the trade session yesterday, the markets, like I said, tanked versus the dollar on the release, and look what happened. Even the objective weekly opening range low held. That's a tell. That's a tell. So long position yesterday, basically right ahead of the U.S. Open was the play here to play the recovery. Weekly open resistance was the target for me, so 33.30. It's still going. If it breaks through the weekly opening range high, this actually would be a decent play still. Okay, and look at momentum. Look for a change in behavior here into the close of the week, guys. If we break the weekly opening range highs, 33.65, momentum breaks 70 or 60 rather for the first time this week, that would be a change of behavior. Okay, that would be a change of behavior. So, in the scenario, if you're holding dollar shorts, if you're looking for a new opportunity to kind of play some sort of recovery in the dollar, I think CAD is the one that I favor a little bit more so. Although at this point you've already made a little bit of a move here, so curb your expectations. But pretty decent. The one thing I would add to the chart at this point is a new retracement here. It's actually the same retracement from the report because we didn't make a new low. Targets on the upside if we do break 33.85, and outside reversal day close is 34.15. Any questions on dollar CAD? Do keep in mind, again, tomorrow you do have on tap CPI data from Canada as well as retail sales data. So not sure how much the retail sales data will move, but consumer price index, we are expecting to hold at 1.4%. So if we get a variation there, you might see some play. Okay, that is dollar CAD going once, going twice. Number 3. Number 4, let me just hit the other ones that we liked for the dollar rally. Here was sterling heading into the FOMC. Here's the last update. So here's the pound. We were looking for the downside break of that pitchfork. This was into the start of the week, right? Resistance at 34.09, 31.21, the 618. Basically a support break of that was what would give us a nice push to the downside in sterling. We did get it, okay? And again, really a very strong tell in that even when the dollar was getting massacred yesterday, you saw that this thing couldn't make a move. I was talking with the guys on the desk here. Even as euro was making fresh session lows, this thing couldn't even make a rally towards the weekly open. And again, that push, that counter push, I should say, in the face of dollar weakness is a very strong tell, guys. And these are the ones that you want to operate on quickly, decisively. At the same time, you don't want to get too enraged with them because you are going against the broader dollar breakdown. So 31.71, 31.21. There's the 618. We're tagging it now. Okay. I got nothing for you. If you're looking for a fresh trade setup here, it's really tough to get enthused about anything fresh. If you get some sort of recovery where you can take a short against the FOMC high, which is 32.50, might be a nice play to 30.50. The key support's still 30. I don't necessarily know if we get quite down there. Remember, dollar CAD or sterling is still in a broader uptrend, guys. We've been talking about this trade for a while. We're simply coming off uptrend resistance, okay, with some really decent divergence, I might add. So, if we get back to that parallel, that's like 30.50. That's right here. Look for support. 30 is going to be my near-term bullish inval, but it's sort of the game plan here for sterling. Sterling and CAD still the favored moves on a dollar recovery, on a little bit of a bounce. Ultimately, we're still looking for those to find some exhaustion a bit lower too. Any questions on the British pound? That is number 4. And let me just take a look at this too real quick. Bear with me one moment. See if there's any fibrillations to the decline. Okay, so this is actually 2 legs lower from the high right here, guys. Huh. Might be a little bit more of a bounce here. Remember, these are my I tell you guys this all the time. These are my favorite Fibonacci confluences. 100 off the high or low, and a 618 off the lower high. You get the picture, right? 100 off the high, 618 off the lower, vice versa. These typically are decent pivot points in price. Again, just look at the crosshair to the left. You can see some decent pivots along this range anyway. That's just to say, guys, that on this move, if we do settle lower into the U.S. trade session, expect that 30.50 tag at least. Should be a decent pivot. Okay, that is British pound. I don't think there's anything weekly we need to put too much emphasis on. Yeah. And again, one of the things that I just like to point out whenever we're looking at these longer term formations, because sometimes we look at these, we don't really know how to react to them. But this is a perfect example. Remember, I always tell you guys, outside reversals at the high, typically really nice reversal patterns. If it's a reversal to the downside at the high, same thing if it's a reversal to the upside off the low, right? These can be very bullish patterns. When you get an outside reversal higher into the highs, that's typically exhaustion. And here's a primary example of how that's playing out. So again, just a quick lesson there on where the outside reversal happens matters. Okay, not just the fact that you got it. A lot of people would just say, "Oh, outside reversal to the upside, that's bullish." Well, not when it's at the highs, right? This is a bullish candle down here, not up here. So expect a pullback there in sterling, ultimately still in this uptrend. Let's double back to last night's update. Number 5, here's Aussie. And we might as well start on the weekly chart since we're here. Here's Aussie dollar. Not much to get excited about on the weekly chart. So the breakdown completely reversed. Obviously, we were looking for a move lower earlier in the week. We blasted right back through the yearly open. There's not really much to look at here on the weekly charts, guys. I just want to note that we are literally sitting right in the middle almost of the yearly range. The 50% retracement is just below where we are. So, there's not a clear cut necessary to, larger encompassing bias here yet. Okay. Daily chart for Aussie looks like this. Okay, here's the pitchfork we've been following off of last year's highs. Here's the median line. A little bit messy, but we're checking that now. The more important level that I highlighted to you guys earlier in the week, and actually in the open of the week, if you remember, one of the levels we were looking to short off of if we got up there was 71.40, 71.39. What is that? It's a good thing we just talked about it. The outside reversal candle we made for that last spike high in February. Another example of an outside reversal candle off the highs, offering a nice reversal lower. Into the lows, you made an outside reversal right off of support. That was the low day close for the year, 70.005. The low that we registered was 7003. Here's the rebound. Okay, here's the rebound. Another example, outside reversal day yesterday into the highs, but still failure. That's an exhaustion trade. You made a new high in overnight trade, but I still think that's near-term exhaustion. Okay, you're not able to find assertive move above that high day reversal close, the outside reversal, which was 71.40. Here's what it looks like on the intraday chart. So the downside break, here's a formation that we were following right into the release, right? Jamie eyed this one out really nicely early in the week. Here's that slope resistance. Here's the upslope that we've been following here in the intraday charts, right? We broke this. We talked about it yesterday. We hit the 618. We recovered right back in the confines of this formation. And right ahead of the release yesterday, we said if we stay in this formation, we have to look for that, possible tag of 71.40 again. Here's the tag of 71.40. You overshot it. Super strong divergence. These are your really nice levels, guys, especially when the peaks are back to back with such magnitude. Higher high in price, lower high in the oscillator. Again, bring it into a line chart. It's a lot cleaner. Lower high. Right off of the upper parallel. So here's the median line. Even if you get down to 71.15, even a tag of that former slope resistance, you're still making the assumption that it's made the breakout, right? Bullish invalidation, I hate to leave it down at the monthly open, but that's the thing that would really shift me lower, period, right? Because you have the upslope here. Yeah, we tagged it, but both sides saw acceleration on the breakdown and the break back above. We rebounded it right back off. Here's the move lower. Looking for support into one of these levels, a trigger, exhaustion, something to possibly take another resumptive trade. But the problem is with all these moves is not only did they stretch really hard yesterday, they all came into major levels. So the inherent expectation of, yeah, you'll see some kickback is there, but also you're seeing some kickback off resistance. That's what has me so uneasy about trying to get back short dollar right here. And Puja, same thing on the euro. That's my only problem. I would love to get a little bit more of a deeper cut to get long again. Just seems too simple to jump on board. And not only that, I hated the fact that once that did happen, you saw all these people on Twitter start, dollar is done, dollar is done. That's when you want to get shook, guys. That's when you want to take a step back because, like I always tell you, the market does not reward the masses. So if everyone and their mother is starting to become super bearish, then that's where you want to kind of like tone back. I'm not saying that we're bullish dollar. I'm just saying tone back the expectation. If you get a decent reversal lower, let's get back in. Okay, any questions on Aussie? Oops, sorry about that. Pooja says, I have a gut feeling that the cut needs to be deeper, but that's not objective. Pooja, we're in the same boat, which is why if my gut feeling is kind of going against what I need to do from a technical standpoint or from a risk tolerant or risk management standpoint, we have to always default back to being prudent. But I just going on sentiment, going on the move, going on where these moves turned. I don't think it's outside the realm that you see some sort of mean dollar roar before we just completely break down again. And know your setups. It's not going to be carte blanche across the board, right? Like I said, sterling, specifically dollar CAD, both that I like, on the dollar recovery, euro on a pullback, even Aussie on a pullback for the dollar breakdown resumption. Let's go over Kiwi because Kiwi was also a big player yesterday. And I just wanted to say that, man, yesterday we were coming into a huge region of resistance, massive region of resistance. So this short, I hope you guys took it because it was well warranted. 69.22. More importantly, we talked just a little bit higher, February high, objective level. Guys, we're coming up against the entire yearly range extremes. These are trades that you want to get involved in. These are the ones that will give you the best risk to reward and typically will be your better plays. Here's the weekly chart for Kiwi. And a darn thing changed. This is the same chart we've been looking at. Where's Kiwi's previous update? Right here. Okay, here's what we looked like last night. So weekly chart, huge level, 69.30, massive, 50% retracement of the entire 2018 range. You have the long-running 200-week moving average. You have the objective yearly opening range highs. Everything's loaded for you right there. Okay, momentum. Same 60 level holding resistance. We still haven't tagged it, right? We still haven't made any change in behavior after the oversold condition. Remember, that's the reversal change, right? When we're coming from oversold, coming above 60, that's your resumption to the high move. Once we break the 60 level to the downside, we dip into oversold. If we hold 60, you're still in the resumption of the down move again. So this is big, big resistance. Here's Kiwi dollar in the daily chart. Oops. Okay, here's the range high, 69.22, 69.30. Here's the objective high of the year. Here's slope. So just in case you needed an extra piece of extra strawberry on top of that resistance range, basic parallel off the high, right? Little did we know, we added that to the lows that we made here and extrapolated. Once we got the break, it's been accelerated move. Look where the peak for today's high touched. You can't make this stuff up, guys. So even these long-running, longer-term, slopes, guys, it pays sometimes just to leave them on your charts because the markets can come back and test them months, even years later. So even on an intraday level, that did offer some tell. So here's your yearly open, right? Here's your yearly opening range. You just tested the yearly opening range and failed as momentum continues to hold those swing highs. Here's the intraday chart. One last nugget of information that we highlighted last night was the fact that on the rally, okay, again, daily chart, intraday chart, on the rally, if you take a basic slope support off the lows from last week and this week's low, a parallel off of the high we made last week, converged on that same zone. So February high, range resistance, longer term slope resistance, the opening range highs for the year, right? And the 50% retracement on that longer term chart, all lined up right there. We turned the high that we registered last night was literally 69.38, like 2 pips ahead of it. So look, this is another one that is, I think, really well primed. You're trading against a major critical region of resistance. Your first target on the move lower is upcoming here at 68.89. If you're holding shorts, do something there. Stops at break even. Next downside level, I would take a soft, maybe a little nugget off here if you get into the opening range highs, but key support is the weekly open, 68.46. I don't know if you get quite down that low, guys. A 618 of the advance gets you somewhere here. I mean, let me just show it to you. I was looking at this morning. A 618 of the advance gets you somewhere like here, which is pretty darn close to the weekly opening range high and where we rebounded post FOMC. So on a stretch, yeah, 68.70 should be your next downside target, but this is my first line in the sand, and that was the high day close for the year. High day reversal close, I might add, off the highs. Some really nice examples in price, guys, over the last couple of days. It's been phenomenal. And if you're someone who's just getting your feet wet with technicals, or you're newer to the service, guys, this is where our stuff shines, right? These critical levels, trading against major range, hidden resistance that people won't be looking at, just major technical levels. So quick adjustment to that new high. All other levels look the same. Any questions on Kiwi? That is number 6, Kiwi dollar. Okay, let's hit the last of the dollar majors, and then we'll hit some commodities. And Pete, you in the room? Are you good on the SPX or what? It's pivoting into support, Pete. So just watch this next level. We'll take a quick look before we wrap up the session. But let me just finish up with dollar yen here. So the last of the dollar crosses was dollar yen. I haven't personally been involved in this one, but it was actually, again, another decent trade yesterday on the breakdown. Here's what dollar yen looked like into the release of FOMC. So objectively, we were talking about this in the webinar, it made a really clean weekly opening range right into the median line for this formation that we added off the highs. This was the first test of the median line, so we didn't know if there was much merit to it. As long as we stayed below the weekly open, we kind of wanted to stay focused lower. Well, we broke through the weekly open ahead of the FOMC, and then we failed at the weekly opening range highs. Here's the result. It was a tough trade, but I mean, there was some time to get in against the high once it started to break down. Here's the drop, and here's the recovery from oversold after hitting the lower parallel, right? So again, a trade which you could see a little bit more rebound before it starts to fizzle. Not one I'd like to play the long side, even though we are coming off of support. I still think you could see a longer term tag. Here's dollar yen, first of all, on the daily chart, right? So a couple things. This is, or yesterday's close did validate and is an objective break of the monthly opening range. Here's your monthly open. You set a high, you set a low, you fail ahead of the highs, you break and close below the low. That happens to be a slope support where you're watching. That happens to be a 618 level for the larger range from the decline off last year's high. Put a gun to my head, I'd say stay bearish below that slope line. Now, there's a couple of things that's kind of making me uneasy. A, the measured move, okay, means that we're at the 100 now. So if this is a complete fake out, guys, and this is just correction, we're gonna resume higher, this is kind of where you would want to see failure. So I'm really uneasy about dollar yen. It could go both ways. At the end of the day, I'm bearish. I'd have to say objectively, I'm bearish sub 111. Okay, that I don't know if that helps you guys or not. It's 40 pips off from where we are now. You could see another 40 pip ripper. But if we were to fail at 111, specifically the median line, that still would, keep me looking for a tag, or at least another move lower. Because remember, we broke slope support. Now you could say, well, why don't you use that second low, and that opens it up to the low we just made, which again shows a perfect tag. But we have to be as objective as possible. Remember, the more touches, the more beneficial. So this slope, when we extrapolated it off the high from January, literally caught the February highs, guys, to the pip. And although we did spike through it early in the month on a closed basis, it's pretty much a turn. So this is what dollar yen does to you. It just slices you up and makes you second guess yourself. I don't know. I don't know if we should be working with this slope and we're at support in dollar yen. Look for a larger rebound. Look for a more definitive move if we recover towards 111. It's the only way I'd look to play this, really. All right, an indecisive Boutros on dollar yen. Nothing new there, but that's what we're looking at with the abomination. Peter says, I'm here. Take a look would be great. Thanks. I got you, Pete. No worries. So, pistol to my head. Look for a recovery to fail at 111. And again, the lower parallel would kind of be the objective there, but yearly open resistance. I don't have a decent retracement for the advance because I hate using this wick. So if I were to use something like this, it actually puts the 618 below the yearly open. So let's see where that 38.2 comes in. Another reason, yeah. Just watch out here. It's about prime time. Dollar yen washes out some hands. Okay. Let's look at trades that are a little bit more clear into the close, shall we? Here's what gold looks like. This is number 8 on the move. So, man, another ripper. Broke the weekly opening range highs. Another one that we talked yesterday ahead of the release, talking about the fact that kind of peaked through 113, but once we recovered back through it, that's something that you want to pay attention to as basically putting you back within the confines of the formation that we were following. So yesterday, what I wanted to highlight was 1321. It's a level we've been talking about for a while here on SB and even on the reports on daily effects. It's the 618 retracement of the drop, but like I always tell you, my favorite setups, 618 retracement of the drop converges on 100 off the low. That gives you 1321, 1323. I still think you could get it. Momentum doesn't look all that encouraging at this point. I'll show you the intraday chart in a moment. But on the daily chart, look at a couple of things. Former slope support, break, saw acceleration, test of resistance, saw a hold, test of resistance, saw a hold yesterday. And here we are again, kind of kicking back there. It converges basically into the start of like next week still. But objectively, you'd have to stay basically constructive above 113 again. Okay, break above 1323. That's the breakout level. You're looking for 1332. You're looking for 1341, 1342 on an extended move. But the question here that you want to ask is this fizzling out just ahead of our level and it could see a kickback all the way to slope support? Or is this just test of the median line? You could still see another spike into that before you turn lower. That's what we're trying to assess right now. So the intraday chart levels remain the same, but we're just turning literally pips ahead of target. What do you do here? If you're holding longs and it starts to settle sub 1313, monthly open support, monthly open resistance, now support, I'd bail. Because below 1313, the objectivity of the upside focus starts to diminish, because that's also a break of the objective monthly opening range highs, right? So if we start to dribble lower here into the week, it gets a little concerning that you might see a larger washout. I'm constructive above 113. We need to see 1323 break to get the next extension higher in gold. Here's gold on the weekly charts, by the way. Perfect break of resistance, test of support, former resistance. Do we fizzle out here for another move lower? Still got some room before you head into major weekly resistance. Okay, crude, man. So this thing is Well, here's the chart. It's sitting at resistance, okay? It's a huge resistance level that we've talked about here at length. I know all of you are aware. We talked about 60.06, 59.61 way early on in the year when we turned finally with that first weekly reversal off of major key support. And the top side break of the pitchfork specifically, that's the major target. This is a huge pivot in price. The weekly close is all I'm looking at here. Any long exposure you have on crude, we're out. Okay. Um, if you're looking for fresh long exposure, listen, if it settles and closes above this 60 level, I mean, I guess you could chase it, but there's really no effective place to put a respectable stop here. Now, if you're holding long still, a good area to take a little off and go break even on the rest, but look at a couple of different things, guys. If we close a weekly trigger and momentum above that resistance trigger, and price closes above 60.06, I think you have free reign for a larger rally. I do think it gets to 63 eventually, guys, but right now this is resistance. Okay, three-way confluence again. Last year's open, typically you're not going to use that the following year, but again, it's been a decent pivot in price. The 50% retracement of the entire decline, this takes into account all of 2018 trade. It's just the median of that range. More importantly, this is what I'm looking at. This slope offered so many turns: support, resistance, support, breakout, acceleration. Once we broke that parallel again, acceleration, right? The median line, again, support. Look at that thing on a closed basis, was wicked into the close of the year. Boom, right off it, right? Here's resistance. Same gradient, but now you have the 50 and last year's open. So look, we got to look for something here. All right, we got to look for something here. It's got to close above for me to continue favoring the long side. This thing could hold right here. Momentum could hold right here, and you could get a pretty mean, kickback. I don't know. All I know is that the long call was for this level for the last couple of months. We're there now. Chill out. Okay, chill out on the long side if you're holding crude. That's the weekly chart, guys. 1,000 feet up. Here's what the daily chart looks like. Okay. Again, sort of an objective level that we're looking at. Top side break, you're looking for parallel. You're looking for the 200-day moving average. But, if we settle at or above 60, momentum is above 70 on a daily close. That's, man, last time we saw a real, peak above 70 was right here. So it's a little concerning, right? A little bit different of a pitch, a little bit different of an attitude in where we are from what we've been doing in momentum. But you get the picture. This is a huge inflection, guys. And if we settle above, expect further advances. If we settle into or below, I think you get some kickback. Ultimately, we'll look to buy that too. But that would definitely shift our near-term focus lower if this holds. One more piece of evidence that I was looking at, and this is something I was looking at yesterday. It wasn't a reversal candle, but yesterday's candle was an outside candle, right? So an upside outside candle, or a bullish outside candle into the highs. Possible risk for exhaustion. And that's been my whole gig, guys, for the last couple of days on crude. You guys know we've been loving the long side. Once we broke the monthly open, we broke slope resistance. It's been a slow grind, but it's been moving higher steadily. This was the first major target. We're there. Use some caution here. Use some caution. Here's the intraday chart. On an intra-week basis, intraday basis, this is the slope we've been working with heading into the release. Right? It could still spike into the upper parallel, which is why I allot that. I allot that possibility if you're holding longs. You might want to leave a little on here. Look, 59.60, that 50%, it pivots right here on that 75% gradient line. If you see this kind of bounce near term, really, I'm talking really near term stuff, guys. You could see another tag of the parallel before it turns, and that actually might give you a third reference point for divergence, which would be pretty nice. Actually, a possible short scenario, but just curb your expectations here, guys. Curb your expectations for the long side of crude. I think it's been a beautiful play. The risk for exhaustion does hold as you're sticking around this 60 handle, the 60 region. Any questions on crude prices? This is number 9. Okay, and that's everything that's on my list, guys. Let me take a look at the SPX here, Pete. I was kind of scoping this out. I sent a chart to someone here in New York earlier that I was talking to because he saw that report that I put out. Or not that report. I sent him a personal report. Anyway, here's SPX on the daily chart. This is what I've been showing you guys. Look, what I'm focused right now is on the pivot at 28.12. So remember, Pete, yesterday we were talking about the 28.12 level, how that's actually been a pretty decent offer for some pretty decent price action. I don't know, man, for the last like 6 months. Here's October, resistance, resistance, resistance. There's resistance again, February, resistance again, outside reversal day. Stayed there for another 2 days before he finally popped higher. Really short-lived. And the interesting aspect is that divergence in price and the momentum oscillator. So he made a clear higher high in price and very objective lower high in the oscillator. Now, we always say these things have no bearing on time. We could get another divergence for another 6 months before it turns. But if you start to break support after such a scenario, well, that's something to pay attention to. Bottom line, I'm looking at 28.12. Let me adjust some of these levels real quick. Monthly open would be the target. If we do break and settle lower, oops. Hmm, hmm, okay. You know what pops out over and over again, Pete, is this 28 level, 2803, 2802. So that's going to be 100% off the high, even if it's corrective. Two equal legs get to 2802. 38 off the low is 2803. That's just from the low of the month, so just a monthly retracement. And then you have this pivot range here of the high day close and the monthly open. So I know that's a handful, but let's just kind of put things on a cleaner keel here. And then let's see if there's any slope. Let's get this to a 60-minute chart. Ooh. So yeah, on a trade like this, listen, I really can't stress how much of a hairy region this is. This is a big pivot, and 28.12 on the peaks, on the reversal and breakout, and on the support has been pretty solid. It's just another fib, but objectively, price has reacted there. So Pete, I would say like the objective focus is still lower, sub 28.33. That goes against the fundamental thing, right? Okay, they're not kicking rates higher. Markets should rally. Yeah, you can take that story, try to take it to the bank. You see if that cashes out. But what price action is saying is that we've turned. We're testing that key pivot region that was resistance on the way up. If we break lower, I think, I think you're in for a larger decline here in risk. Long story short, this was the FOMC high. So objectively, you're kind of lower below that. I wouldn't even weight that high. I'd be objectively lower below 28.30s. Near-term support on a downside move beyond this, I'd be 28.02, 28.03. If we crash this, we get through the monthly open to the downside, that's straight bearish. Okay, that's straight bearish. You'd look for a much bigger problem for risk at that point if we break monthly open support. But that's my take on SPOOs. Momentum's getting tired. The way that it's turning certainly is very provocative on the back of what should be perceived as good risk data, right? Lower rates is a more accommodative stance from the central bank, and you'd typically see stocks hold. But just remember, again, the opinions are ridiculous right now, guys. You could read, like, whether you read Bloomberg, Reuters, CNBC, it doesn't even matter. They'll have, you know, guys that are saying, oh, the Fed's taking a victory lap, and there are guys that are, oh my goodness, the Fed is basically marking that we're in for a reset. They're all over the place. So focus on price, guys. What this should or should not be for the dollar is irrelevant to what price is doing. If we break support, specifically at 28.02 on a near-term front, I do think you're in pretty deep trouble for a larger correction in risk. Make sense? Peter says, thank you. Great as always. I appreciate that, Pete. If there are no other questions, we'll go ahead and wrap it up here, guys. Thank you, Michael. Have a peaceful and relaxing weekend. Thank you, Iman. As always, guys, it's been a pleasure. Best of luck trading into the close of the week. And we will pick things up on Monday on the free session and on Tuesday and Thursday back here on SB. Cheers.